The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this month's Pensionmark webinar series with JP Morgan, where we'll be going through the Guide to the Markets and Economy for Quarter 3 of 2015. We appreciate all of you taking the time to join us today. We just have a few items to go over before we get started. First, to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we'll take some time to go through these questions. And now I'd like to introduce our guest speaker, Jack Montague. Jack is a Vice President and Client Advisor with JP Morgan Asset Management. In this role, Jack is responsible for delivering timely market and economic insights to financial advisors and their clients, as well as consulting them around the depth and breadth of JP Morgan's investment solutions. He has served over 10 years in the financial industry and is responsible for the Los Angeles and Mid-Coast region with JP Morgan. Jack is an avid golfer and recently became the father of his first child, Patrick. Jack and his wife, Kelly, currently live in Culver City, California. Thank you so much for joining us today, Jack. Now I'll go ahead and turn it over to you.
Thanks so much, Tori. Thank you for having us on this morning's call. We appreciate your partnership, and thanks everyone for joining us this morning. We're going to do a couple things. For those of you who have been on these calls before, we're going to quickly run through who is JP Morgan and why I am on this call today as a partner firm to Pensionmark. And then we're going to go through our Guide to the Markets, which is part of our Market Insights series. We're going to be discussing the third quarter Guide to the Markets, which was just released on the second business day of the quarter, to discuss all of the major financial headlines and themes, investment opportunities, and risks that we are seeing in today's environment. So first off, who is JP Morgan, right? We are actually one of the world's largest, most respected financial institutions. JP Morgan is a name investors know and trust for steady, consistent management across rapidly changing markets. We're actually the 7th largest mutual fund firm in the U.S., and we manage $1.7 trillion of clients' money, which is entrusted to our investment professionals and within our investment products. The goal of today is to talk about the experience that we have in managing money through all types of market environments like the ones we're seeing today. We've actually managed investments for more than 150 years, and this has given us a valuable experience across all market cycles. For example, during that time, we have guided investors through the Civil War and every conflict and crisis since. We've experienced 31 recessions and recoveries that followed, and we've adapted to shifting politics worldwide, including 29 different U.S. presidents. So through all the changes, our mission remains the same, and that is to help clients achieve life's most important financial goals. We do that through one of the world's largest investment professionals. We actually have 900 investment professionals in local markets around the world, and our portfolio managers average 17.4 years of manager experience, which is actually 3 times the industry norm. Research is very important to us, which is part of the Market Insights guide that we're going to be discussing today. We actually have a $269 million annual budget to research investments globally every single year, which is an astonishing number when you think about it. That's the money that we outlay just to go around the world, kick the tires, meet with companies, do our due diligence, and find suitable investments for our clients. So the Guide to the Markets, which we're going to be discussing today, is by far one of the most commonly used tools among financial professionals, institutions, governments, and retail investors like yourselves to help navigate and simplify the complexities of the market. It is printed over 160,000 times every quarter. It's printed in multiple languages, and it is available on 4 different continents. So with that, let's get into really the highlights of what we're going to be discussing on today's call. There are several themes that need addressing in today's economic environment. First, of course, is the Greek debt crisis. Second would be the U.S. economy. Third is the Federal Reserve and the timing of interest rate hikes. Fourth is profits and equity valuations. And lastly is global investing and some of the benefits that we're seeing there. So let's jump right into it. Let's talk about page 45 from our guide, which discusses Europe, their sovereign yields, and their fiscal austerity measures. The right-hand side of this page shows that, contrary to popular belief, Greece has actually pulled their deficit by 9.5% over 3 years. It's really a staggering number, and because of the austerity that's been imposed upon them by Europe, it's not difficult to believe why Greek voters voted no on the recent referendum. Yet, it's also difficult to understand why the rest of Europe is reluctant to lend more money when they may not get it back. If the Syriza is winning in Greece, it may empower other left-wing governments in Italy, Spain, Portugal, etc. to follow the same path. So we believe that even if Greece does come up with a new proposal, Europe will most likely decline it. The most important question for an investor is, will there be contagion? Will this Greek debt crisis spread? And recent volatility may be due to a fear that the situation in Greece may be contagious. In reality, it is likely not contagious. Given the three possibilities, first of which being economic, second financial, and third a political collapse, the first is that Greece is insignificant from an economic perspective. They only make up 2% of European GDP, the very small portion of the overall growth component. Second, when it comes to financial, the bailout program was designed to actually get Greek debt off the books of European banks and onto the books of governments, the ECB, and the IMF, which can actually handle the debt. And third, it's unlikely that any European elections in the coming months will result in the rise of an opposing party, although Italy may be a long-term threat. If you actually look at the chart on the left, you can actually see European sovereign debt yields. So back in 2011, early 2012, when the first Greek debt crisis arose, you can see Greek yields spiked up to roughly 15%, 14.98% to be exact, and it dragged other regional European yields up along with it. There was a fear of contagion because the risk may spread. If you go to the far right side to early 2015, you can see that Greek yields are starting to spread higher, while the rest of the Eurozone remains low as the quantitative easing takes place. In essence, no one really believes that contagion is going to affect the rest of the region as we see it today. So let's move forward to page 18. Let's talk about the economic growth and the composition of United States GDP. While the first quarter GDP was weak, recent numbers that we're getting actually suggest a second quarter GDP may be around 3%, which is quite good. The right-hand side of the page shows a checklist of the economy. Right? It's housing will be a big contributor. Investment spending data is mixed right now. It may slightly add to growth. Government spending will not add much, but there is growth in construction spending. Consumption spending looks better than 3%, and net exports likely won't be a drag on the second quarter as they were in the first quarter. We actually may see a revision in the seasonal adjustment process in the last few years, which could get rid of the 0.2 negative number for the first quarter. And if that first quarter actually gets revised to positive 1%, it may take something out of the second quarter. So overall, we will likely see a bounce back in GDP in the second quarter of 2015. Some other interesting things that we're going to note are on page 20 of the Guide to the Market, which focuses a lot on the cyclical sectors of the U.S. economy. We look at light vehicle sales, we look at housing starts, we look at manufacturing and trade inventories, and then we look at real capital goods orders as some leading indicators. And the right-hand side of page 20 shows a pickup in inventories, actually. We're also seeing that elsewhere in government data, which suggests there may be a problem with manufacturing inventories down the road because companies will need to work through this inventory in order to stop detracting from growth in the coming quarters. Overall, we think growth will bounce back to 3%, but it will slow to 2.5% going forward. This is a repeat of the pattern throughout this expansion, because growth is not going to pick up the way that it used to. We're not likely going to see 4% or even 3% on a regular basis. And with the American economy, this may actually be the new normal. So moving forward, let's talk about the long-term drivers of growth. The cyclical sectors are the leading indicators, but let's talk about page 22, where we can actually see some of the long-term data that we've been discussing. Now, the right-hand side of page 22 shows GDP growth over the last 6 decades broken down into growth in the number of workers and growth in real output per worker. So this combination will be the growth in real GDP. So we've averaged 3.8, 3.5, 3.3, and 3.1, and currently where we stand now, we're at 1.6, 1.7. Over the last 50 years, we've actually averaged 3.4% growth in real GDP. Now all of that is essentially gone. So the bottom left-hand side of this chart shows that we are not doing enough investment spending, and that takes away from productivity growth, right? So if you don't spend more money to make your employees more productive, then you can't have a growth in GDP because the employees and the companies are not growing at the historical numbers. The number of workers is going to quickly reduce growth in the labor force as well. Population demographics of people aged 16 to 64 shows that this is going to be even slower in the next decade when you take a look at the forecast on the top left right-hand chart. So over the next year and a half, we may have a growth rate in the U.S. of 2%, maybe 2.5%. And if the unemployment rate reaches 4% and doesn't fall any further, growth will have to be under 2% by 2017 or the economy will overheat. Essentially is that we're not growing at the same historical levels that we may, and eventually this is going to catch up with the U.S. economy. Some further data to support this conversation is actually on page 24 of the Guide to the Markets. It actually discusses unemployment and wages here in the U.S. The unemployment rate has fallen from a staggering 10% in October of 2009 to 5.3% today. However, wage growth is still very weak at only 1.9%. However, there isn't enough history and better measures of wage growth to show a pickup in compensation right now. So why have wages been so slow to tick up? Well, first is inflation. Inflation is low, so workers are not demanding higher wages to offset their new higher costs. Also, with less productivity growth, as we just mentioned on the last slide, businesses are not inclined to supply wage increases. So essentially, if companies are not getting a more productive worker, why would they pay them more money? So the next question is, will the unemployment rate, the brown line, and wage growth, the blue line, move closer? So we at JP Morgan think they will probably move closer as the unemployment will continue to come down a bit and wage growth will come up again a bit. Now, if this is the case, then the Fed's criteria for tightening interest rates will have actually been met. It's actually a good thing. And also, if the dollar stabilizes and wage growth stabilizes, the Fed will be confident that we will head towards that 2% inflation number that they've been targeting for the past 5 or 6 years. So let's move on to a real important topic right now. Let's talk about page 33 and the Federal Reserve and interest rates. By far one of the most hot-button topics for investors, governments, and institutions, and retail investors today. Now, let's talk about the top line. The top line actually shows that the Fed expects 1.9% growth in 2015. This is in the top right box with the FOMC June 2015 forecast, which we actually believe correct, that 1.9% number. They believe in 2.6% growth next year. We also believe that is correct. 2017, they're calling for 2.3%, which we believe is unlikely. And in the long run, they're calling for 2.2%, which we also believe is unlikely. We believe that the long-run growth will be closer to 1% or 1.5% until the baby boomers' retirement is complete. This goes back to the past 3 or 4 slides that we've been discussing, not only with the changes in cyclical sectors, but also in the long-term drivers for growth. We also do not agree with their unemployment forecast, which is 5.3% in the 4th quarter of this year. We are already at 5.3%, so we believe that the unemployment rate will be closer to 5% at the end of this year. The unemployment rate could fall over a percentage point to 4% by the 4th quarter of 2016. Now, the Fed is expecting 2 rate hikes this year, which you can see in the bottom line, the blue diamonds, which are actually the FOMC's year-end estimates. You go from 0.13 up to 0.63. at the end of 2015, up to 1.63 at the end of 2016, 2.88 at the end of 2017, and then the long run of 3.75. So again, if you do the math, the Fed is expecting 2 rate hikes this year. That's 2 25 basis point hikes, 4 in 2016, and 5 interest rate hikes in 2017, which sounds about right to us. Now, we think that we will have a rate hike in September of this year. We think they will skip their October meeting and rate a second hike in December of this year. It seems the Fed is anticipating skipping every other meeting in 2016, but they may find that the labor market and inflation are heating up faster than expected. So rising interest rates are going up because the economy is getting better. So if we could move our attention now to page 7, which discusses corporate profits and leverage inside of the U.S. market. Analysts are really expecting a turnaround in profits. You can look at this on the far left chart. You'll see that operating earnings were down 5.3% year over year in the fourth quarter of 2014 and 5.5% year over year in the first quarter of 2015. Now, in the second quarter of 2015, analysts are expecting a 3.1% year-over-year decline. It's possible that we'll actually be flat for second quarter of 15 and on the upside in the third quarter of 15 and the fourth quarter of this year as well. However, meaningful gains may not come next year with possible double-digit gains. Overall, we see a rebound in profits this year with bigger gains in 2016. So let's talk more about earnings. This is obviously an important topic, not only for investors, but also for the growth of companies in the U.S. Page 8 will actually discuss the sources of S&P 500 earnings and where we have been. So one of the questions I'm sure you're asking yourselves is, why were first quarter earnings down? The answer, in short, is because of oil. Energy was clearly a big drag on earnings. We don't believe that the underlying earnings in the U.S. Energy companies were actually negative. We will probably see some pickup in earnings growth in the second quarter and in the rest of the year, even if oil prices don't go up. On the dollar, which is also a very important topic, 54%, as you can see on the bottom left-hand chart, of U.S. corporate revenues came from inside the United States, which means that 46% of revenues came from outside of the United States. So this is important because if you have a rising dollar, which has appreciated 17.8% in the second quarter of 2015, you do the majority of your business overseas, you have to repatriate that money, in which case you will have to adjust for the higher currency, which will deteriorate some of your earnings. Now, on the right-hand side, again, you can actually see how the dollar has gone up. This implies a big translation effect was pushing down the value of foreign earnings, as I just discussed. So overall, oil was a drag, the rising dollar was a drag, but if you look to the S&P 500 contributions to earnings by sector, other areas actually did make money: financials, healthcare, industrials, technology, telecom, utilities were all positive. So if you take a look at the first quarter 2015's earnings per share growth year over year, on the top right, you'll see that the S&P 500 had negative 5.6% earnings. However, if you simply took energy out of that calculation, the earnings in the United States for the other subsectors was 8.5%. So let's go more deeply into the energy conversation. Let's talk about page 29 of the Guide to the Markets. On page 29, you'll see the energy, supply, demand, and prices of oil. The bottom left-hand side of page 29 shows that inventories fell by 300,000 barrels a day in 2013. Inventory grew 1.1 million barrels in 2014 and 1.9 million barrels a day in 2015. Forecasts show they will grow by 800,000 barrels a day in 2016. Now, the EIA is assuming that the effect of a 50% reduction in oil prices, which we've already seen, will gradually shut down production and the increase of consumption. We believe this to be correct at JP Morgan. We actually expect oil prices to be higher a year from now. If oil prices increase, this will help corporate earnings. And another big topic that we're watching very closely right now, I'm sure investors and anyone who watches the news is, the Iran deal complicates this, but if U.S. Congress will approve a deal, Iranian oil will seep into world markets over the next year, creating more supply issues. So that's our quick snapshot on the energy conversation. Let's take the conversation to the second part of the earnings discussion and focus on trade and the U.S. dollar on page 28. This page reveals two things. One, it reveals that the dollar is too high. Second, the long-run dollar will actually come down. The dollar is too high because we're running at a big current account deficit. While oil may play a small part in that, the trade deficit will probably get worse. Europe, Japan, and emerging markets are all currently running at account surpluses, believe it or not. We are running at a trade deficit because our assets are too expensive and everyone else's are too cheap. If your trade deficit is causing a demand for foreign currency, then it will tend to push the foreign currency up and your own currency down. It is a weak force that is getting interrupted by people's assumptions about how markets will react to Fed tightening and rising interest rates. If the European economy will improve over time, the euro will go up. If you believe the euro will go up in value, it is better to invest in European stocks unhedged. If the dollar is flat or down and oil is flat or up, profits will gradually recover. So very interesting things happening within the energy and in the currency discussions. So let's jump to the next topic of our conversation, which is the profitability and the valuations for the S&P 500 here in the United States, and is our stock market overvalued? Page 5 of our guide to the markets actually shows the S&P 500 valuation measures. This is a brand new slide that we've introduced to the third quarter guide to the markets, and it's actually one of my favorites. It actually shows page 5 will show the forward PE ratio, which is operating earnings expected over the next 4 quarters divided by the current price. So the forward PE on the S&P 500 is currently 16.4, while it has averaged 15.7 over the past 25 years. Thus, we are only slightly overvalued. The biggest anomaly is still in the relative earnings of stocks and bonds, in the top right chart, which you can see. Stocks still look cheap relative to yields that you can achieve from bonds, cash, or inflation. While we don't think that the market is overvalued, we only expect single-digit returns going forward. So this is a cool chart. Again, the current valuation on the S&P 500 is 16.4. The average is 15.7 times, but a full 1 standard deviation to the positive would actually leave us roughly at about 19 times. So at 19 times, we will start to have the discussion like some of the other financial houses on the street discussing extreme valuations. But in our current viewpoint, we are only slightly overvalued, and we do believe with the growth in earnings that we discussed earlier, stock prices do have the capacity for single-digit gains going forward. Now, let's also talk about manufacturing momentum. This is an important discussion not only for the U.S., but also for the global landscape on page 44. This is Dr. Kelly's, the author of our guide to the markets. It is one of his most commonly used and one of his favorite slides. It discusses as a leading indicator global purchasing managers index for manufacturing. Essentially and simply stated, green is good, yellow is neutral, and red is bad. So if you have higher manufacturing momentum, that means you are producing more manufacturing goods and services, which you then hope to sell and deploy on a global basis, which means you have to hire more people to actually manufacture those goods, which should bring global unemployment down, which should bring global incomes up. Hopefully there's wage growth to go with that. You will then also have an increase in consumer spending, and as we know, the U.S. is a 70% consumption-based economy, so it's one big snowball. The better the manufacturing data, the better the forecast and leading indicator for overall GDP growth on a global basis is. So as a general rule of thumb, what we note here is PMIs in emerging markets look weak, and PMIs in the developed market look okay. So we currently favor the developed market over the emerging markets in the short term. Now, let's also take a look at page 4 of the Guide to the Markets, which shows the S&P 500 index at its inflection points. This is a very interesting chart because people can think about this two ways. If you take a look at the far right, you can see that the U.S. market is close to an all-time high. We're trading at a higher price than our two previous peaks, and we're also trading at a dividend yield in the central box at roughly 2%, which is slightly higher than the October 2007 peak, and it is higher than the March of 2000 peak. So still attractive dividends on a relative basis, but people are worried about the price. Now, the bears immediately look at this chart and say that we are due for a pullback. It probably should have happened in 2012, 2013 if you take a look at the trends. The bulls in this chart automatically look at the valuation measures. The top right chart has that 16.4 valuation for the PE as it stands today on June 30th of 2015. If you go to the far left, bottom left-hand chart, you'll see that the forward PE on December 30th of 1996 was also trading at roughly 16 times, but the market went up 106% from there. So again, if you believe that earnings and the economy is getting better, you believe in higher stock prices, which we believe at higher single digits, but we're also concerned that we have come too far too fast. The same is true for the international markets. A very cool chart that we have in our guide on page 43 actually shows the MSCI EAFE, which is the Developed International Benchmark, at its same inflection points. So things that we note here very simply is that the MSCI EAFE is actually lower and cheaper than it was in 2007 on a price basis. It has a higher dividend yield than the U.S. at 3%, and it is cheap relative to German bunds. Earnings are moving up in Europe as the economy improves, and there is a lot of opportunity in European stocks and some opportunities in Japanese stocks. So investors today look at the first chart of the S&P 500, and they look at the international, and they realize that there may be some opportunities overseas based off of some cheaper valuation and price metrics. Let's take a quick snapshot at emerging markets and their economic snapshot, which you'll find on page 50 of the guide. Page 50 shows the difference between emerging markets and developed market growth and the ratio of the MSCI emerging markets to the MSCI developed markets. Emerging market stocks are underperforming relative to developed country stocks. This is because of the expectations of economic growth, which are falling in emerging market countries. Everyone seems very negative on emerging markets, but the commodity cycle is coming close to bottom. China is growing more slowly, but India is growing very rapidly. Meanwhile, developed markets are running out of available workers. Unemployment is 5.3% in the U.S. and 3.3% in Japan. Overall, the U.S. and Japan will grow more slowly, and emerging markets will grow more quickly. Since the gap between emerging markets and developed markets will widen, emerging market stocks will probably do better in the long run. So let's take this conversation further. Let's take a look at page 35, which talks about developed market divergences. Page 35 shows the different paths being taken by central banks. The U.S. and the UK could see nominal GDP growth at all-time highs, while Europe and Japan are lagging behind. If you look at the balance sheets of central banks on the upper right-hand side, the Bank of Japan and the ECB are expanding their balance sheets, while the Bank of England and the Fed are not. Expectations for interest rate hikes are anticipated for late this year or early next year for the U.S. and UK, but not for many years in the ECB and the Bank of Japan. If you want to invest in fixed income, we are not going to get beaten up by a tightening central bank because there are opportunities in Europe and Japan. When speaking about global fixed income opportunities, we have to address emerging market debt, which is on page 40. The right-hand side of page 40 shows the U.S. dollar-denominated sovereign debt relative to treasuries. In India, for example, you can actually get 1.66% on sovereign debt yields over the U.S. debt, of which the maturity is only 4.8 years. So it is unlikely that India will default over the next 4.8 years. In regards to emerging market debt, you need experienced managers to figure out where the credit risks are, because not all countries are created equal. Not all credit ratings are created equal, and you have to take a look at real policy rates for both emerging markets and developed markets to find out where the arbitrage and mispriced asset classes take. But generally speaking, yields in emerging markets are highly attractive relative to developed markets. So in short, let's talk about asset class returns and talk about building portfolios for the long term. The biggest distortion in financial markets, and we're on page 54 discussing asset class returns. Again, the biggest distortion in financial markets is the fact that cash is paying you zero currently. Central banks have made it so your clients and investors can only make money through investing rather than saving. The global economy is doing okay, yet people are getting distracted by grief. The U.S. economy is doing better, and valuations are not too high in the equity markets. And it's a good time for investors to take advantage of corrections and uncertainty to get invested in long-term assets. This is especially true when short-term assets are paying zero. So what we look at on page 54 is the historical asset class returns for the past 15 years. So what we note is that it is very difficult at any given point to pick the best performing asset class in any calendar year. Take example commodities on the top left of the year 2000. The best performing asset class one year, and then in 2001, second worst performing asset class in 2001. So if you build an asset allocation portfolio, which is a diversified portfolio of a multitude of asset classes, countries, stocks, bonds, and alternatives, you can have a much smoother ride where you can see asset allocation has never been at the top two performing asset classes, but it's also never been in the bottom three. The far right will show the 15 years annualized returns. Asset allocation over this time period returned your clients 5.3%, while large cap stocks alone, i.e. the S&P 500, only returned 4.2%. So asset allocation does work. It actually generated 20% higher returns over the past 15 years when compared to just large cap stocks. And in terms of the volatility, asset allocation came in with a volatility that was roughly 4% lower than large cap stocks. So higher returns, lower volatility, stay fully invested, build strong portfolios that work for your investable goals and your risk profile, and you will achieve your goals in the long run with all confidence. So Tori, that is the end of my comments for today's update. If you'd like to open it up to any questions, I would be happy to address anything that anyone would like to discuss.
Absolutely. Thank you so much, Jack. We really appreciate you sharing your time and your knowledge with all of us here today. And as you mentioned, we will now start addressing some of the questions that have been filtering in. Doesn't appear that we have too many questions at the moment, so I'll give you guys just a couple minutes. And just remember, if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. I'll go ahead and pull that contact information up on the screen. You can reach our call center at 888-201-5488 or email us at info@pensionmark.com. And again, it doesn't appear we have any questions at this time, so we'll go ahead and wrap up today's webinar. Thank you again, Jack, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.
Thanks, everyone.